you both share the view that earnings are not going to be the nectar to the market that maybe some would like it to be. Burns, why don't you explain first why you feel that way?
Well, we could see stocks continue to move forward, but it probably won't be earnings, at least in the near term. We still expect this to be a muted earnings season with overall market earnings being flat to slightly down. And really, if there's probably going to be one driver, and in fact, really the driver of stocks, even in today's action, it would probably come from the macro fronts, resolving any of the geopolitical issues, such as, we've had good news coming out of the Brexit negotiations and the fact that we've had a little bit of a temporary ceasefire with the U.S.-China trade. What it seems those have done have steepened the yield curve a little bit, and that's something that it's positive for the financials, it's positive for cyclicals, and really it's positive for value equities as well. And I think that might actually be a bit more of a driver for the remainder of this year than earnings even.
Patrick, if it isn't going to be earnings that take the market higher, I guess the question could go one of two ways. What will it be on the one hand, or conversely, is the market kind of whistling past the graveyard here and pricing in too much good news for its own good?
Yeah, I think I'm on the camp that the market's pricing in too much good news for its own good. I look at the China thing, and I think that would be the single biggest positive catalyst to move the market higher. China hasn't really confirmed the phase one progress that the administration seemed to trumpet. That's a sign as to, maybe there's some wait and see on trade. And I think that there's still more risk to the downside, honestly, Tyler, than I think there is to the upside. Trade would be the single biggest positive. But I do feel like with the S&P at 3,000, there's a fair amount of complacency out there. It's hard to construct a scenario where, as Burns just said, where earnings are really the catalyst. Brexit is a nice little positive. But really, trade is the big overhang. And I still feel like that's more likely to skew negative than positive in the near term. And in the meantime, there's kind of a slowing out there generally. I listened to both Citi and JP Morgan this morning, and they both talked about no real signs of trouble, but definitely a slowing of growth. And I think that's really the theme. And is the market at 3,000 really pricing in that slowing of growth?
So, Burns, I know you said that earnings won't be the fuel for the overall markets, but could they be the fuel for individual sectors? And specifically, I'm taking a look at healthcare today, which is the best performing S&P 500 sector, thanks to United Health. You like healthcare, but healthcare has been trapped in this vortex of political concerns, which has really brought the group down. Today, finally, with UNH earnings, it seems to be breaking free of that. Is that going to last?
I think that could be a little bit of a driver on a sector-by-sector basis, and healthcare is a great place to start with that, as you noted. When you have earnings season, that is the one period where you have a lot of company-specific and stock and sector-specific news, and so you have a little bit of a divergence between the winners and losers. It tends to be a good period for stock pickers, and healthcare is one of the places where you have some of the best earnings growth, you have some of the best dividend growth. Of course, it's the sector that's lagged the most this year, which means it is trading at a discount, although I think it's a place for investors that have a little bit of a longer term, a 2 or 3 year time horizon, because one of the things that's really dragged it down this year is it has had a target from both sides of the political aisle, and that's probably going to continue to be the case at least through the 2020 election.
Patrick, do you have a value sector that you like more than any other, and if so, why?
Yeah, so, Burns and I both do value. It's been a long 12 years in the value wilderness for anybody trying to value companies on their fundamentals, and I'm sure we're both waiting to get out of this desert. But we're probably a little bit deeper at Brandywine into that value desert, and so I really like energy. It's a stock that no one else I talk to likes. They hate it, and there's the old joke about you really don't think a stock is hated till you hate it yourself. And energy is just out there. But the thing that is interesting about the sector is when we look at some of the bigger producers, some of the integrated oil companies, at $60 Brent or, low to mid 50s WTI for crude, these companies are generating double-digit free cash flow yields. They have attractive dividends. As long as oil doesn't go down $15 or $20, some of these major oil producers are very, very cheap, some of the cheapest stocks in the world. And I don't know who's left to sell them because everybody I talk to hates them.